welcome. My name is Marcel. I help agencies run more profitably. This is what I do. I'm the CEO and co-founder of a company called Parakeeto, and we work exclusively with digital and creative agencies to help them measure and improve their profitability. I'm also the fractional COO at Goldfront, which is a creative design agency and category design agency out of San Francisco, where we've gotten to work with some pretty cool brands like Nike, Uber, Slack, Adobe, etc. I'm also the head strategic coach at SaaS Academy, where I've coached over 500 SaaS companies doing anywhere from $10 to $1 million a month in revenue. And I host a podcast all about agency profitability called the Agency Profit Podcast. So make sure you check that out if what you hear today sounds interesting to you. And as Jeremy mentioned, I'm here to do a bit of a presentation to really talk through the handful of numbers that you need to pay attention to if you're running an agency. You'll know how to calculate them, what the benchmarks are, et cetera. And what I'm hoping is that you can walk out of here with just a little bit more clarity on how to make sure that the business is healthy, and you have some simple tools that you can use to gauge your performance at various times throughout your growth. And then hopefully we'll have some time at the end to dig into more specific questions that you might have. So very excited about today. Before I get into it though, I also have a question for all of you. When it comes to agency profitability, what's your biggest challenge, your biggest fear, the thing that stings the most about this? I'd love to hear some feedback in the chat, just so I can make sure I cover some of the things that are most relevant to you. So let me know in the chat, when you think about agency profitability, what comes to mind as a challenge for you, something that you're unsure about, that you struggle with, et cetera. Let's see, churn.
Do you want the answers? I can watch the chat. You can do the presentation.
I got the chat up here.
Okay, good.
Keeping flow of billable work. Yeah. So keeping utilization high and making sure that work is coming through on a consistent basis. That's definitely a tough one. And a lot of that has implications around staffing, right? We don't want to be hiring people at the wrong time and having them sit on their hands and paying them to sit around. Accurate projections, definitely a tough one, right? We'll talk about that a little bit as well. Some of the things that we hear a lot are these kind of three core things. Number one, sometimes it's kind of unclear what to measure and how to measure it, right? What are the numbers I should be looking at in my business? What exactly is the calculation for some of these things? We take a simple, air quotes, simple metric like a utilization or an average billable rate. And on the surface, it sounds like a very simple metric. And then you start asking people, well, what exactly is somebody's capacity? What's included in that? What's not included in that? What about weekends? What about paid time off? What about holidays? What about non-billable time, right? This gets very complicated very quickly. And oftentimes when we work with larger agencies, different people in the organization have different definitions for the same metric and the same objects within a metric. So it becomes very problematic. So there's that whole challenge. And some of you are struggling with this, it seems. The second is messy data and systems. So even if you are clear on what you want to see, it can be challenging to get the data together, pull it together from different tools, and have this be a process that can happen without a ton of friction or a ton of time, ton of data cleanup going into it. And lastly, you might just be guessing and stressing. You might just not have data available when you're making important decisions about things like pricing, hiring, scheduling work, et cetera. And this can make it even more stressful to run an agency than it already is. And believe me, I know it's very stressful running an agency to start off with. Being an entrepreneur is just tough. And there's no reason why we want it to be even harder by having to make these gut feel decisions or kind of shooting into the dark on things that are mission critical to our business. So my objective for today is, unfortunately, we don't have all of the time, but we have enough time for me to at least start and clarify the clear metrics and benchmarks that you should be measuring in your business, and provide some high level insight into how you can start to use these to look into the future. So that's what we're going to be focused on today before we open it up for Q&A. We have one more piece of feedback in the chat here: how to encourage and not penalize non-billable work that is biz dev in nature, what to do with it in the bonus calculation. So generally we have your question captured, and I'm excited to dig into this because I think it's a great topic. And hopefully you'll have some clarity here in the short term on what you can use to measure bonuses. So here's what we're going to start with.
Oh, we're lost.
One moment, I need to unmute Marcel. 1 second.
Sorry, I broke your rule. I had to cough and then I hit the mute button.
Oh, right.
Sorry. Okay, so I'm not supposed to mute myself. All right, so here's what we're going to start with today. we're going to cover these kind of three key things: core financial metrics that you should be paying attention to. And then we'll talk about some tools that you can use that are very inexpensive and very fast to get more frequent and more detailed insights than financials are really capable of giving you in an efficient way. Now, I want to start this first part by prefacing and saying, I'm not a CPA. We are not an accounting firm. We don't do bookkeeping for clients. We're not a finance firm. However, most of you on this call today probably have some kind of finance system in place, whether you're doing your own bookkeeping or you pay somebody a couple $100 a month to do this for you. So the reason I want to start with this is because it's probably the easiest, lowest hanging fruit for most of you to get a ton more insight into your business without spending any additional time or money, just by making a couple of simple changes to what you're already doing on the finance side. So we're going to start with core financials, and this should give you the high level understanding of what does a healthy agency look like, and everything else will kind of cascade from that. So let's dive in. I want to talk first about what are the core financial metrics that you should be able to see when you pull up your profit and loss statement every month for your agency. It starts with, of course, revenue, all the way over here on the left-hand side. If you can't see your revenue on your profit and loss statement, then you've got a serious problem and you probably need to change whoever's helping you with your books to somebody else. This is probably the most basic of all the metrics. How much money is coming into the business? That you should be aware of. But the second piece of this is one that most of us cannot see on our profit and loss statement, which is how much of that is AGI, agency gross income. And the difference between revenue and AGI has to do with how much pass-through revenue you have coming through the business. And so for some of you, you might not have any pass-through revenue, but examples of pass-through revenue would be things like ad spend, print budgets, white label partners, outsource vendors that you are pushing revenue out towards. And really the way we think about this is money that's passing through your business into another vendor that you are not responsible, or we are not responsible for the profitability of. So as an example, if I am selling a $10,000 a month retainer to manage somebody's Facebook ads, and $6,000 of that is going to Facebook as advertising spend, that to me is a $3,000 a month, or sorry, a $4,000 a month retainer, not a $10,000 a month retainer. The money that's left over after I pay the ad spend that I have to now earn with my time and make a profit on is $4,000. So we really want to be diligent about stripping out revenue that is obfuscating our ability to understand the true size of our business and start to measure the true efficiency of our business. Another good example of this would be, if we were looking at Visa or American Express, their revenue is not all of the money that passes through Visa card. It's the 2.75% fee or whatever it is that they're taking. That's their actual revenue. Just like Airbnb, their revenue isn't all of the bookings that go through their platform. It's the 15% cut they take in the middle. Now, examples for your agencies are probably not as dramatic, but it may be material, and it's something that you definitely want to isolate and pull out. So that gets you to your AGI number. It's very important that you be able to measure this. And for most of us, the way that looks is we're using the cost of goods sold section in the profit and loss statement to isolate these things. The problem with that is AGI on your profit and loss statement, if you can see it, if it's being properly calculated, is probably called gross margin or gross profit. And of course, this is not your gross margin or your gross profit, because your pass-through expenses are not your cost of goods sold. This is just revenue that doesn't belong to you. And so what we have to now do is understand our delivery margin. And we do that by isolating now our delivery costs. So we have to measure, what does it actually cost us to earn that AGI? And usually the majority of that cost is going to come down to payroll and shared delivery expenses. So there's probably a pretty significant portion of your payroll, usually about 60% of your payroll, that's going towards people whose job is getting work done for your clients. Maybe those are employees, or it might be freelancers, but we need to isolate that payroll. And so the problem that I see most people have on their profit and loss statement is all of the payroll for the entire company, for everyone that's working for them, just goes into one line called payroll. And now it's really kind of hard to parse apart. Well, how much did it cost us to earn this revenue? How much of this payroll was for getting work done for clients? So we need to be able to split the payroll account out. And the second account that tends to be problematic is software. All of the software for the whole business goes into one line called software, but there's probably a whole bunch of tools that you're using. QuickMail is a great example, where it's like, we don't use this for just one client, but we need QuickMail to do the service that we offer to our clients kind of more generally. So QuickMail is a good example. Tools like Figma or stock footage libraries, Adobe Creative Cloud, these are all good examples of shared delivery expenses where it's like, this is a tool that our delivery team needs to do their job and to offer the services that we offer to clients. And we want to be able to isolate those delivery costs so that we can understand how much do we have to spend to earn $1 of AGI. And our target for this is we're generally trying to get to a 60% plus delivery margin on the profit and loss statement. So what that essentially means is we don't want to spend more than, on average, 40 cents to earn $1 of revenue in the business. This is probably the most important metric that almost none of the clients that we audit are able to see on their profit and loss statement without doing math or without breaking accounts apart. And without this in place, it's very, very hard to run a profitable agency. This is the foundation of profitability for your agency, because of course, if you don't have much delivery margin, then you can't really afford to spend the appropriate amount of money on overhead, and it's very unlikely you're going to have a whole lot left on the bottom line. So this is a critically important metric and one that hopefully you can leave here today and start to measure in your financials, which will give you a ton of insight into how fundamentally profitable are your service offerings. From there, we then start to look at overhead spending. So how much of our money is going towards running the business? And this is when we generally want to break overhead spending into 3 distinct categories: sales and marketing, admin, and facilities. And in total, we want to try to keep our overhead spending to between 20 and 30% of our AGI. This would include salaries in those buckets, oftentimes a portion or all of your founder salaries, as well as anybody that you're hiring for admin or sales and marketing work. And then of course, all the tools, software, advertising spend, rent, utilities, et cetera, that go into this. We want to generally keep this between 20 and 30%. And what that means is that we should have 25% plus left over as profit at the end of the year. This is after we have paid ourselves a market rate salary as a founder, which we'd generally be capturing in here and in here. So this is at the high level, what we want the business to look like and some of the benchmarks that we want to be able to aim for. And hopefully this allows us to get a little bit more insight on a monthly basis from our financials. And so, yes, Chastity, I appreciate that my handwriting is a little hard to read. So these 3 buckets are sales and marketing, S plus M, admin, and facilities. Those are kind of the 3 key buckets. And so to give you some more specific benchmarks, sales and marketing, we usually want to be between 8 and 14% of AGI, admin between 8 and 12, and facilities between 4 and 6, for a total of 20 to 30% of our AGI going towards sales and marketing. So this is kind of the high level. Hopefully you can kind of take this clip, take this screenshot, bring it to your bookkeeper, your accountant, and say, hey, we need to be able to identify these things on the profit and loss statement going forward. And what this should do is give you 12 shots on goal. It's a very Canadian metaphor to use per year to try and get the business heading in the right direction. But here's the problem. You only get 12 usually, unless you want to spend a lot more money on bookkeeping and do this more often, which usually isn't feasible because you're probably not accruing revenue in that detailed of a way. And so there's all kinds of issues with financials. They're not that frequent. Usually you're only seeing this 15, 20, sometimes 30 days after the month is over because you have a bookkeeping cadence. The books need to get closed and reconciled. And it's very, very expensive to now take this and start to try and get more detailed, start to look at specific clients, specific projects, perhaps specific phases or milestones or different elements of projects. It's extremely expensive to start getting more timely and more detailed with financials. And so how do we get more frequent touch points without adding a ton of overhead or a ton of expense to this process? And that's where we're going to start talking about the next metrics here, which are our earning efficiency and utilization. Before we do that, we can go through an example of these core financials. And yeah, any questions about this, you can start to drop them in the chat and we'll answer them. So to go through a practical example here, let's imagine that in our agency, we have done a total of $1.5 million in revenue. So we have $1.5 million. And then we have about $500,000 in pass-through expenses here. So we had some advertising spend, some white label partners. So we had about 500K in pass-through. So that means our AGI for this business is $1 million in this time period. Next, we spend about $400,000 on delivery costs, right? Which is roughly 40% of AGI, which is good. And that includes payroll and some shared delivery expenses. So what this means is our delivery margin is $600,000. It's $1 million minus 400K, which gives us a 60% delivery margin. That's pretty good. And then we have our 600K delivery margin, which is now essentially the money that we have to operate the business. We spend, in this case, let's call it, sorry, I've got some notes here because I don't like doing math live on calls. We spend $140,000, as you know, I should, because I'm liable to make mistakes. We spend 100K on admin, and we spend $55,000 on rent and facilities, et cetera. So that puts our total overhead spending at 295K, which is roughly 29%, 0.5% of AGI. That leaves our operating profit at $305,000, which is roughly 30.5% of AGI. That's really good. We're doing really, really well here. So that is kind of the very simple math on how all these numbers work together in a practical example. And just to kind of remind everyone, the formula for how an agency makes money is AGI, $1 million in this case, as an example, minus direct labor costs, which in this example is 400K, or delivery costs, sorry, minus overhead, which in this case is about 300K. And that is what gives you your profit. And so what I want to focus on today is I almost never, so we audit a lot of agencies, we look at their financials. I almost never see an agency being really irresponsible with overhead, super overspending here. Most agency owners that I talk to, they're fairly frugal. They're fairly, good at managing the overhead of the business. They tend not to buy, $700 chairs for all their staff or try to rent like a massive office space. This isn't an entertainment 720 situation from Parks and Recreation. For those of you that are familiar, where you've got NBA players on retainer to shoot hoops in your lobby just so that you look cool to clients. That's typically not what's happening. The issue 98% of the time is the gap between these two numbers, the delivery margin. So what I want to talk about today is some different levers that we can pull to improve the relationship between the revenue that the business earns and what it costs to earn that revenue. And that's what creates the air and the oxygen for the business to get better. So that's what we're going to move into next, talking about earning efficiency and utilization. Before I do that, I want to pause. Any questions about core financials before we move on? Going once, going twice.
This is okay. We're going to put them and collect them toward the end.
All right.
Don't worry.
So let's talk about earning efficiency and utilization. These are kind of the two really useful, really inexpensive tools that we can use to get much more frequent insight into the performance of the business when we are kind of waiting for those more precise monthly touch points on core financials. So here's what we're going to talk about next, earning efficiency. So there's two ways to measure earning efficiency, which is essentially this high level understanding of how profitable are we at a fundamental level. The first one is delivery margin, which we've just talked about. And so just to kind of remind everybody of the formula on this, it's AGI minus delivery cost over AGI. That gives us our delivery margin. So in this case, 1 million minus 400 divided by 1 million is equal to 60% or 600K. Okay, so that's how we would do delivery margin. But of course, the problem with this is we need to have some way of like accurately accruing our revenue for a given time period. We need to accurately accrue our delivery costs for a given time period. This is a fairly expensive metric in terms of the inputs that it requires. So what's the simpler way to do this? It's using what's called average billable rate, ABR. It stands for average billable rate. This has also been called effective hourly rate, or EHR. Really what this means is for every hour that we work in a given time period or subsection of the business, how much revenue do we earn for every hour that we work on average? And so the way that we do this is we take the AGI for any time period, any section of clients, projects, phases, milestones, what have you, and we divide that by the delivery hours required to earn that revenue. Delivery hours. And you might call it a billable hour. We're talking about the same thing here, probably, but I don't like the word billable hour because it has connotations that have to do with billing the client, which makes it more confusing than it has to be. What is the amount of time that was required to get this work done? That gives us our average billable rate. So as a simple example here, if I had a $15,000 project and I spent 100 hours on that $15,000 project, then I probably made $150 per hour. If, for example, I spent 200 hours on that same project, then I would have made half the money, $75 per hour. So this is a much simpler way that we can start to look at patterns across the business, different clients, different projects, different departments, perhaps different phases within a project. Where are we more efficient and where are we less efficient? Karen, do you mean you should include unbillable time, bookkeeper, et cetera? We will talk about that in a moment. When we talk about utilization, we'll talk about the definition of a billable hour. But in short, no. The question of whether or not an hour is billable has to do with, was it required to move a deliverable forward, but has nothing to do with if it changes the price for the client, right? So like if I told you, hey, I'm gonna bill you $5,000 for this project, and that's based on my assumption that it's going to take X number of hours at X hourly rate, but it ends up taking me twice as many hours. All of those hours that I had to use to move that project forward are billable in this context. There are delivery hours in this context because they were required to get the job done and they affect our efficiency. So we're not including any time that is not directly working on the client project. So bookkeeping, no. Sales, no. Admin, no. But any time that's required to move client projects forward in that time period, we would include in this definition. So we'll double click on that a little bit later, but that's the initial answer to your question. Hopefully that's helpful. So let's go through a quick example of this. We've got 3 different projects here. This would be like a simple report that we could run where we go, okay, here's 3 projects that we've done recently. We did a website, we did a brand design, we did a funnel build. The website had the highest revenue, but we had some pass-through. We hired an external vendor to help with maybe the development of this. So our AGI was 50K. We spent 500 hours on it. The average billable rate was $100. Okay, not amazing. Brand design, we had a $20,000 project. We had 5K in pass-through. So our AGI was 15. We spent 100 hours on this. So that means we made 150. Okay, that's definitely better. And then lastly, we have our funnel build. We hired a white label partner to do almost all of this work. So we only had a $10,000 AGI, but we only spent 50 hours on it. So that means we made $200 an hour. So you can see here that this starts to give us a lot more objective clarity on some of the things that really drive efficiency, which is how much cost do we have to incur at a high level to earn revenue on these different types of work, which pulls us away from the vanity of who's paying us the most money, because that's not really relevant in the context of efficiency. It's probably relevant in the context of cash flow. It's probably relevant in the context of revenue, but really what's going to move profitability is efficiency and trying to replace as much revenue in the business with high quality revenue that is highly efficient, so that the capacity that we have on the team can be deployed against things that earn us more money for every hour that they work. So that is a simple example of earning efficiency. And what's cool about this is we talked about AGI and delivery margin as one way to measure earning efficiency. We can do the same thing with average billable rate just by using the same formula. So if we understand our average cost per hour, we can take our average billable rate minus our average cost per hour for, again, any subsection of the business, and divide that again by our average billable rate. And this will give us a sense of what our delivery margin is in that given area of the business. So it's less precise, but I would say that it is almost just as accurate in terms of giving us some insight into where in the business are we fundamentally more profitable without all of the overhead or lag that comes with using a financial metric to measure this. So hopefully this is helpful. That covers off earning efficiency. So we're down 2 out of 3 that we're going to cover today. The next one we're going to just quickly cover is utilization, which must be looked at in conjunction to average billable rate. These two should always be looked at together, and I'll explain why in a moment, but this is the last piece, which is really asking the question, how much of the time that we are buying from people is being used to earn us revenue? Very, very important question. So let's talk about utilization and what it means. Utilization is a function of how much capacity do we have in a given time period, how many delivery hours are being worked in a given time period, and then how does that relate to our target? The formula for this is the following. We have our delivery hours or billable hours divided by our capacity. in a given period of time. So let's define these two things very quickly. A delivery hour, as I kind of alluded to earlier, is any time that's required to move a client project forward. So if I had to spend time talking to the client, working on their project, writing code, designing things, writing documents, if I have to spend time to get something done for the client, that's a delivery hour. And capacity is all of the time that's available that's being purchased from a given person. So for a normal American employee, at least, that's about 2,080 hours per year. When I sign an employment contract with an employee, I'm usually saying, hey, I'm buying 40 hours of your time for 52 weeks a year. I'm going to give you some of that back for holidays and vacation and paid time off, et cetera. But we don't want to strip any of that out. We want to leave all of the capacity in there. So most people in a year, it's 2,080 hours. And then what we want to measure is how many delivery hours were worked in that time period. And this is the same calculation for a month, for a week, for a quarter, for a year. It's always the same. There's a couple of reasons that we want to leave it that simple. The first is it makes it far less expensive to calculate, because now I don't have to chase down things like holidays, time off, sick days, non-billable time. I don't have to get any of those inputs to do this calculation. It also makes it more horizontally consistent. So it's easier to compare one time period to another, because I don't have all of this external variability that's affecting the basis for the number. And the third reason that we like to do it this way is it doesn't remove the cost of non-billable time and non-billable team from this metric. Because what you might find is that your utilization is low, and it's because your team isn't balanced. You have too much of your payroll going towards people that don't earn revenue for the business in terms of moving client deliverables forward. So all of that is considered in this modeling, and it also happens to be far easier and far simpler to calculate. So in this situation where we have a certain amount of capacity and we are working fewer delivery hours than we need to hit our target, this is a pop quiz question for everyone. So perk up here. What are the two options that we have to get to our delivery target? How do we get to our utilization target here? We have a certain amount of capacity, we're working a certain amount of delivery hours, but we're not quite there yet. We have two options here. Anybody want to take a guess in the chat at what those options are? How do we get to our utilization target or close this gap? Option number one is we can lower capacity. Never a fun thing to do, right? We have to fire people, lay them off, convert them to contractors, but it is one option. If the basis is lower, then we have the same amount of delivery hours, but we have fewer people that we've got to pay to buy their time. Therefore, the calculation starts to work itself out. The other option is we can get more hours. But here's where there's a major issue, right? If I start telling the team, hey, I need you to hit this certain utilization target, but there's no more revenue or no more work for them to do, then what starts to happen? We just start spending more time to earn the same amount of revenue. There's no upside to that. In fact, there's a substantial downside because we're just being less efficient at doing the same amount of work. And we start setting really bad expectations for clients about how much service they're going to get from us for the price that they're paying. So this is why we always want to look at utilization coupled with average billable rate, because this is what happens when we only focus on utilization. The team spends 200 hours instead of 100, and our average billable rate goes down. And so if you notice your utilization is starting to go up and your average billable rate is going down, that's an indication that you have not adjusted utilization in the right way. You've not done it through increasing the amount of work that the team has to do. There's just an arbitrary inflation of hours that's happening in client work, and that comes at absolutely no benefit to the agency. In fact, I would say it's very detrimental in that it starts to obfuscate how much time it actually takes to earn that revenue. So I would much rather have low utilization and a high average billable rate, because that's a solvable problem. I can sell more work to do that, than a really high utilization and a low average billable rate. Because it's a lot easier to go out and sell work than it is to figure out how to get substantially more efficient at doing the work that we're already doing. That's a two-step process. I've got to get more efficient and then fill the capacity. Whereas if I just have capacity, all I have to do is fill it if we're already being efficient. So this is the high level on utilization. So to just give you some examples of this, here's a utilization report that we might run in a given week. We've got 2 full-time employees here in Brett and Janine. This would be like a month. Rochelle is part-time. This is how many delivery hours they worked. That gives us a percentage. And then we have a total across the team. One thing I get asked about a lot is, what should my target be for utilization? So let's talk about that. There's some nuance here because there's weekly targets and there's annual targets. And if we're using the simple calculation that we're using above, then we want to make some adjustments for this. And sorry, somebody's trying to get a hold of me. Do not disturb. I forgot to do that during tech check. All right, all good. So essentially what this should look like is on an annual basis, you want your agency to be above 50%. So you want about 50% or more, ideally closer to 60% of all the payroll, all the time that you're buying to be deployed against things that earn revenue for the business, that move client projects forward. So what does that look like on an annual basis? Pure producers should be 60 to 65% or more. Pure like delivery managers or kind of quasi delivery people, this would be like a design director or maybe a manager of your delivery team. Anything really above 20% is a bonus. And then anybody else, 0% plus, if you can get some billable time out of an admin assistant or out of yourself as a founder, that's a bonus. But the team should be structured such that at the end of the year, you're able to hit 50% or more utilization. If this is not possible, then you have an imbalance of talent on your team, an imbalance of time that's being purchased. And so what that looks like on a weekly basis is you're basically adding about 15% to these weekly targets. So pure producers, we're talking about, 75% plus on a weekly basis. Delivery managers, 35% plus on a weekly basis. Anybody else, again, 0% plus as a bonus. And you're trying to get to consistently 65% plus on a weekly basis. Assuming that you're going to have a bit of a loss here throughout the year for things like time off and holidays, dips in utilization periods where you're just not quite as busy, maybe hiring people out ahead of when you need them a little bit, or laying people off a little later than you should have when you had a drought in work. So all those things are going to happen. So we want to set a slightly higher weekly utilization target so that we have a little bit of absorption power throughout the year, and we can still give ourselves a chance of hitting that 50% mark. If you're not profitable at 50% plus utilization, that tells me that you probably have an average billable rate problem, where you're just not charging enough relative to what your costs are. And so there's an efficiency gap that needs to get closed there. So just to kind of run you through how these levers are really, really powerful and how they can improve utilization, as well as give you some look into the future, I want to run through a couple of simple calculations. Let's imagine I have an agency with 10,000 hours of capacity in a given period of time. This is what I have for staff, and I am utilizing them at 50%. My average billable rate is $100. That means in this time period, I can earn $500,000 with this agency. That's the maximum amount of revenue that I can earn if these two things remain true. If I can increase my average billable rate to $125 per hour, either by pricing things more expensively or just spending slightly less time to do the same work and then filling that capacity, the same business now can earn $625,000 in this time period. If I can increase my utilization by just 5% and remain at $125 per hour, now this business can earn about $687,000, $687,500K. Now, keep in mind here, capacity hasn't changed. So we're not spending any additional money on payroll overhead. I mean, we can choose to, but all of this additional profit, $125,000 here, and about $187,000 here, that goes straight to the bottom line. That's pure profit. And on a $500,000 business, almost $200,000, that's significant. $187,000, I'm doing this in real time, even though I shouldn't. That's about 37% profit margin. So this $25 average billable rate and 5% tweak in utilization is the difference between this business breaking even or losing money and being hyper profitable, 30+% EBITDA on AGI. That's the power of these two simple numbers that you can use anytime for basically any period or subsection of your business. And as long as you pay attention to these two numbers, the profit and loss statement should largely work itself out. So that is kind of the long and short on the core things I want to talk about. Some simple numbers that you can use to figure out how things are going in the business, do some analysis, and really keep yourself afloat. Hopefully that's helpful. The last thing I want to do is encourage everyone to go and grab a bunch of free stuff. We have a toolkit at parakeeto.com. It has training videos, spreadsheet templates, cheat sheets, and all kinds of other things, everything that you need to start tracking these basics in your agency. So if you're interested in taking the first steps at measuring this stuff on your own, feel free to go there and grab that. And of course, reach out to me if you have questions on LinkedIn, via email, what have you. And with that, we're going to go to Q&A.
Well, thanks so much, Marcel. I was planning to ask what if people want to know more about you, but I guess this is the page, right?
Yeah, I mean, go to Parakeeto. If you download the toolkit, we will, of course, like send you all kinds of emails. You'll be on our website. We'll tell you about ourselves. Of course, you can unsubscribe if you don't find any of that helpful, but we try to make it helpful. But yeah, there's not a whole lot to say, really. What we do as a business is we do audits. So we come in and we go through all of these numbers in your business. We go through the whole business with a fine-tooth comb, and we show you exactly how much profit is being lost in the business, what you're capable of doing, how $1 of ABR or 1% utilization impacts you over the next 12 months. And then we help clients build, install, and run these reporting systems. So you can imagine having myself and my team do all of this reporting for you, so you never have to worry about it again. That's basically what we do. We typically are not a fit unless you're kind of over $1 million in revenue, but if you're smaller than that, we put together the toolkit specifically for that reason. So go grab this, and that's really what we've done to try and help agencies that are just kind of getting off the ground, get the basics in place so they have a good chance at becoming successful and scaling past that $1 million mark.
Yeah, seems pretty cool, honestly. So how about we hit some questions? You ready for it, Marcel?
Hit me, Jeremy.
All right. So for everyone on the call, if you have some questions, just put it in, and we'll be happy to read them. I'm terrible at reading. I don't know what I'm doing any presentation of webinars. Honestly, I should pass the baton to someone else, but I love doing them. So anyway, we have a question from Chastity. What if the agency is not currently calculating billable hours?
Yeah, the short answer is start, because if you're not tracking time and if you're not measuring billable hours, then you don't have any measure of your costs going in. And so really what you're left with is the only thing you can do is use financials at that point. And so you're back to, which is not the end of the world, especially if you're just starting out, but you're back to delivery margin as your primary way of figuring out if the business is profitable. And like I kind of talked about before, it's not so bad. You're going to get 12 opportunities a year. You know, if you want to pay more for your bookkeeping, maybe you can do that slightly more often, maybe bi-weekly or weekly if you want to get really aggressive. But you'll get probably 12 opportunities per year to see how you're doing. And you'll see it across the whole agency. So what you'll miss out on there is data that tells you what specific types of clients or services or projects are more or less profitable than others. But hopefully you can fill in those gaps by talking to your team, you know, using your gut. And so if you're early days, you could probably get away with just financials, but this is the answer. If you're not tracking time or not tracking billable hours, you're going to have to rely on financials to measure profitability. And I would encourage you to consider starting to measure time in one of two ways, either using timesheets, or if you are structured in the right way, you could use a centralized time tracking model whereby, and this is how shops like Media Monks, for example, do it, where you have a PM. That PM has a team, and the project manager uses a resource plan as a way to track time for the whole team. If you think about what a resource plan is, it's basically a timesheet. It's just in a slightly different format. And so if you're in a situation where your team members are only ever assigned to one or two projects at a time, then the complexity is low enough that a project manager with daily stand-ups and adjustments to the resource plan can probably do a pretty accurate job of tracking time without actually asking the whole team to track time. It's just the only person in the whole business that could get excited about time tracking is the one who has to do it. So it's a pretty good situation. So this is an alternate way to track time if you're really not interested in timesheets. But I would encourage you to do it, because otherwise it's like running a restaurant with no food cost in sight. It's pretty dangerous.
Yeah, agreed. I think you can come back to the previous slide, because we have a question from Patty that says, where do you account for outside vendors in your earning efficiency formula?
Yeah, so it's a kind of a good question. So there's two ways to account for it. The first is, of course, if they're pass-through costs, then we're going to account for them here, because when we're looking at AGI, or we're looking at, if we're looking at either delivery margin or we're looking at average billable rate, we're stripping out pass-through costs. But if we're in a situation where you've got a vendor that is coming in as like a freelancer, for example, and they are doing work that is core to the business, so they're not really a pass-through cost. It's like, hey, we didn't have enough designers, so we had to pull in a freelancer, or we don't have enough work to hire a designer full-time, so we just use freelancers for that. Well, we're going to want to track their time so that we can include their hours in the delivery hours. And of course, then this is how we measure it. It's really that simple. So hopefully that answers the question. But if there's more nuance to that, Patty, feel free to fill us in here, either in the chat or perhaps maybe we can unmute you. I don't know what the rules are, Christian. Does that address your question, Patty?
Yeah, that's fine. We are on mute.
Yeah.
Meanwhile, where do you put affiliates or referral pricing? You know, like referral fees, sorry. Where do you
referral fees? Oh yeah, I would be putting those in either pass-through. Yeah. Usually we put those in pass-through. Sometimes they'll go into sales and marketing, but generally those are just going to go into pass-through.
Okay.
Yeah.
That makes sense.
Good questions. This is rapid fire. I like it.
It's firing too fast for me. Hold on. Oh yeah, I had another question actually. As you were going through, you know, you were mentioning about some costs are for the entire team. Like maybe Figma is a good example. Like you give some licenses, right? Not trying to plug QuickMail, but we do have something like this cost per client because every client has like different costs. How would you actually look into that, into the formula? Would you actually associate it to just the cost of one project? Like how would you actually associate that?
Yeah, it's a good question. So, and the reason that most of the time that's going into you're going to be putting that into your delivery costs on the profit and loss statement. And that's going to be usually the easiest way to do it because most software is not super easy to attribute to a single client, nor is there like a complete dropping off where it's like we only ever pay for it when we have a client. Usually there's some kind of like a base subscription, and then maybe there's an incremental cost increase on a per client basis. So the simplest way to do this is just to include it in your delivery cost and then set your delivery margin target to consider that. For most people, software as a part of delivery cost is 2 to maybe 6% of AGI. We rarely see software costs increase beyond that, except for in situations where we have one client, for example, that does they do data research. That's the service that they offer. So they have a lot of cost because they're paying for these extremely expensive databases that they have to use to service their clients. So we had to adjust the way that they price and scope things to account for that, you know, outsized delivery cost. And there is very much an incremental cost to adding more clients. So there's a lot of nuance to this, but the simple answer is just put it in delivery costs and don't worry about splitting this out on a per client basis. The cost of that in terms of how complicated it is and how much time it takes to do relative to how much more accurate it's going to make your pricing is just not really there.
Makes total sense. I would agree with that. We had a question from Domenico. It's slightly outside, but I think it's still very relevant. When do you really start optimizing for profit versus aggressive growth?
Yeah, this is a really good question. And so the first thing that I would say is that the two of those things are not really in tension with one another. A mentor of mine once said, do you want to know what growth sounds like? I said, sure. He goes, growth sounds like cash being sucked out of your business, like at an alarming rate. And so I would argue that aggressive growth requires profit. It's just a question of what you choose to do with that profit. So this is where there's some nuance to all of this. And I'm going to say the word nuance a lot because there's a lot of it here. But when we talk about AG or overhead, right, like the important thing is this. If the delivery margin is strong, we as owners should get to choose. Do I want to put 14% back into sales and marketing, or do I want to put 40% back into sales and marketing? Like, that's what I've been doing. I don't need to take a salary from Parakeeto right now. So I put all the money I would have paid myself into getting us more clients and growing faster. But I get to make that choice because we have great delivery margins. So we have lots of money that we get to choose what to do with. And so the thing that I would say is the first step is always making sure that you have delivery margin. And then you actually have a decision to make on how much you put into sales and marketing. The situation that so many people are in is they don't have the delivery margin. And so these expenses feel like they're necessities and not choices. And so that's like the first thing that I would say. But to answer that question more directly, I think you probably don't need to start paying a lot of attention to this stuff until you've broken about 500K in revenue. Up to 500K, maybe $1 million. Your top priority is probably just figuring out how to sell and how to sell more faster and how to do this in a way that's somewhat predictable so that your business is not kind of at the mercy of, not getting referrals from people or, some kind of very lukewarm sales and marketing process. So between 500K and $1 million, until you reach that kind of precipice, your focus should just be really on selling. I wouldn't worry a whole lot about getting detailed about your profitability beyond just maybe having those basic financials in place and measuring your delivery margin. But if you're kind of getting to 500K or $1 million in sales and your delivery margin is like not quite where you want it to be, then it's a good sign that it's like, okay, the next step here is to create a little bit more cash flow. And that's going to come from paying a little more attention to the things I talked about today. Hopefully that answers the question in a couple of different ways.
Yeah, no, I mean, it makes sense. It could also be that, founder has different goals for the business, maybe more like the financial freedom on the side. And so therefore at the detriment of the growth. But yeah, that's a very personal choice at this point. I have a question from Tracy. It's an interesting one. I may also elaborate a bit more on this one. She said, how to determine headcount against revenue growth? And my sort of like piggyback questions to this is obviously as soon as you add someone, you increase your capacity, but obviously, you don't get more money. So you will have that sort of like cliff, I would say. And so how do you actually, compensate with that? Do you, if you're hiring a lot of people or whatever?
Yeah. It's a good question. This is a metric that a lot of people actually talk about, and a lot of coaches in the agency industry that should know better talk about this metric, even though I think it's like extremely problematic, which is this revenue per full-time employee metric. And most of us have heard about this, like, oh, you should have X amount of revenue per full-time employee. And hopefully you can see from this presentation why that metric doesn't make any sense and is not helpful at all. Because what matters, right, if we come back to our formula for this, is delivery margin. What is the relationship between revenue and cost? And so if I have a $250,000 revenue per FTE, is that good or is that bad? Well, it depends on what it costs me to hire people. If I'm in San Francisco, that's probably still not good enough, right? Because my engineers cost me $400,000 a year in San Francisco right now. So I'm losing money at 250. But if I have a lot of offshore team, or most of my team is based in New Brunswick, Canada, then I'm probably killing it. So I don't even really want to answer the question because I think it's pure vanity. There's not really a relationship in terms of headcount to revenue. It's more a question of what is the percentage of your revenue that goes to payroll in those specific areas. And really what's important is delivery cost and payroll relative to AGI. And we want that relationship to be, again, we want about, 40% or less, small to big, 40% or less payroll versus AGI. That's what's really important. That's what I would encourage you to pay attention to. And if you can hire an offshore team and have 100 people working for 40% of your payroll versus AGI, and like that's just the way that you can build your business, I think that's great. And if you live in a more expensive place and you have to hire more expensive people and you only get 10 people for 40% of AGI, it really doesn't matter what that looks like, as long as the work is good quality and the ratio of money that gets spent to earn a dollar is healthy. So hopefully that's helpful, even though it doesn't directly answer the question, because I don't think there is a good answer to that question, unfortunately.
Can I push back a little bit, Marcel, on this one? Maybe I'm slow to understand here. But if I'm hiring like someone totally new, and obviously it will take time to ramp up, then you still consider their full capacity. And so if I'm getting like too many new people and then my capacity growing, but obviously I'm probably net 30. So before I actually gain my AGI will take a bit of time, or you know what I mean? Like there is probably a transition period in which like the metrics may not look good, but it's still okay from the business, or am I getting something wrong here?
So that's actually a really good observation, because that starts to bring into question this whole conversation about accrual revenue recognition. And so that is definitely a challenge if you're doing cash-based accounting. In fact, I would say that if you're an agency and you're doing cash-based accounting, you're going to run into all kinds of challenges once you get to about $1 million or more. But if we're doing this on an accrual basis, then we actually should be able to avoid this problem to a large extent, because we should know in a given time period, regardless of cash flow, how much revenue we have earned in that time period. And we should be able to look forward into the future and understand how much revenue we will have in the future. And we can time those hires. And to your point, Jeremy, like people are not going to ramp up fully, but this is not a function of their capacity and your theoretical AGI. What they should be looking at is your actual AGI. And so it is certainly possible that, and again, this is where there's nuance. You say, I'm going to hire this person for 2 months, we're going to be at 60 and then 50% of payroll versus AGI, but then it'll normalize back to 40. But that's an investment I'm willing to make because we need this person. This is a good hire. The timing is right, whatever that case might be. But really the guidance here is we want to try to get to this relationship at some point. Just like when we talk about overhead up here, 20 to 30% is not a rule, it's a guideline. So sorry, I'm jumping around here, but saying we want to spend 20 to 30% of our overhead or of our AGI on overhead, this is a guideline. We might make the choice to say we're going to spend 50% on overhead because we need to buy this big office because we're going to hire 100 people this year and we're going to grow into it. What's important is that if we had to, or if we executed on our plan, we end up back in this ratio at some point. Does that address kind of
sense.
Jeremy?
No, absolutely. Makes sense. So a couple more questions. We got one from Bryant, which is a good follow-up to this one. Is there any software that covers, profit, sales, MRR, churn, product, expenses, and more in your
I mean,
your knowledge?
Yes and no. Like there's all kinds of all-in-one agency management platforms that try to do this. I think try is about as good as I can offer in terms of like what I think they're accomplishing there. This is the problem that I think we see a lot of people encounter is it feels like right now as an agency owner, you've got to choose between two really bad options. The first is I'm going to use a bunch of tools for things like managing projects and tracking time and doing my finances that are actually really good at the one thing that they're supposed to do. Like one really good time tracking tool, but all it does is track time. One really good project management tool, but all it does is manage projects. But then the problem is my data is spread out across all these different things. The same task or the same project is named slightly differently in 3 different places. It's a real mess to try and get the data together and measure this stuff. So then you're told, well, the answer to that is trade in all those really good tools for a really big, extremely mediocre tool that's half as good at all those individual things because they're trying to do way too much from a product breadth perspective, but at least all your data will be in one place. And I think that those tools do offer a lot of upside from a workflow perspective. They certainly can save you time on workflow because you're not jumping around. But the fundamental issue there is that unless they are very, very intentionally configured, and unless you are militant about compliance on things like naming conventions and use of hierarchy and people not entering, like not forgetting to run their timers, et cetera, it becomes very challenging to get good reporting out of those tools because any error in the data entry side, which is never going to be perfect, your team's always going to make little mistakes there, means that your reports become unreliable. And so unless we have a process for quality assurance at the data entry point, then we often don't get the benefit that we want from an all-in-one tool like, and I'll name a whole bunch of them, Workamajig, Scoro, Function Point, there's all kinds, search those 3, you'll get all the rest of them. And look, they're impressive pieces of software, but this will not be solved by tools. It has to be solved by strategy and design of a data schema before tools can even really become a question here. It's not the tool, it's how you use it. That really is the case here. If we set one of those tools up, but we're not thinking about how exactly are we modeling someone's capacity? How exactly are we defining a billable hour? What is our naming convention or our structure for objects in a project, or how we want to slice out teams? We're not going to get a good outcome from those tools. So I would encourage you to really sit down and get clear on that, and then go evaluate tools against that criteria to really figure out like what is going to meet the requirements that we have for how we want to look at the business and model it. So again, a bit of a non-answer, but also hopefully a bit of an answer. All-in-one tools, search up Scoro, Function Point, Workamajig. Reich is another one. There's all kinds here that have a very wide scope in terms of functionality, but again, they will only get you as far as your, like intentionality on configuration and your diligence on data input.
Fantastic. I'm going to cheat a little bit, actually, Marcel. I'm going to ask you a question, and we discussed about this. You say, oh man, if we run dry, then we can talk about this. It's going to take 15 minutes. So I'm going to challenge you to actually talk about it in 5 minutes, if it's possible. But I thought it was a very interesting question, and I want to know it. How do you think about pricing service by hours versus value created?
Yeah, I'm going to talk about that in just a moment, Jeremy. Before I do, there's a question here that I really do want to address from Jenna Lee about what should we tie bonuses to? And my answer is delivery margin. It should definitely not be tied to utilization for all the reasons that I talked about earlier. Having employees focus on utilization, unless there's one exception to this. The one exception to this is you only ever bill on time and materials, and it doesn't matter how many hours you rack up, the client's always going to pay for all of them. That's never been the case in my experience at any agency that I've talked to. There's no agency that can just bill as many hours as they want to the client and the client will never push back on them. And so if that's not the case, then utilization is not at all a good metric to hold the team accountable to, because it will just drive bad behavior. It will inflate delivery costs, et cetera. So instead, what we should be focused on is this number right here, delivery margin. And the reason for this is it's just an incredibly well-tensioned number. If the team understands delivery margin and they're held accountable to it, it's in their purview. It considers utilization, it considers efficiency, it considers being overstaffed, it considers being understaffed. It really does a good job of creating healthy counterbalances in incentives. It's the best metric that I've found if we're trying to bonus our team on performance that's tied to revenue creation. And it does a great job of insulating you as the business owner of only ever paying out bonuses when you've also benefited from the upside of their efficiency. So that's what I would encourage you to focus on. Hopefully that answers the question, is helpful.
Loved it.
Amazing. All right.
I
So
thought the
let's
same.
talk
That's
about,
why I didn't ask the question.
so let's talk about the agency pricing quadrant. So real quick on this, let me know in the chat if you've ever heard that pricing by the hour is crazy and that you're going to hell if you do it, or that you've heard that value-based pricing is the holy grail. And unless you're doing value-based pricing, then you're leaving all kinds of money on the table. If you've ever heard this kind of dogma in your Facebook or LinkedIn or Instagram feed, then let me know in the chat. I know I certainly have. Seems to be a lot of people banging this drum. My perspective is there's a time and place for various different types of pricing models. And I'm going to talk about how I help clients identify the right pricing model for their services. I use a quadrant. I call it the agency pricing quadrant. Here's how it works. There's two axes. The first is value. So we have a high value service and we have a low value service. So value is driven by two primary things. Number one, what is the commoditization of what I'm selling? So simple example here. If I sell graphic design services, I am extremely low value because there are a million other people who do graphic design services. However, if I help B2B software companies visually communicate complex data systems using design, same thing, I'm doing graphic design, but I'm solving a much more specific problem. So the value of that is higher because there's almost nobody else that has that positioning. By the way, if you know an agency that specializes in visually communicating complex data systems, we could use some help with that. So that's the first example, is what is your positioning and how does it limit the amount of available solutions? And the second axis of value is relative value. So simple example here, if I'm doing conversion rate optimization, if I help Apple increase their conversion rate by 1% on apple.com, that's hundreds of millions of dollars in revenue for Apple. If I do the same thing for my Aunt Shirley, who sells handmade leather bracelets on Etsy, that's a couple $100 in additional revenue. It might take me the same amount of work. The relative value is just extremely different to those two people. So those are the two primary considerations around value that make up most of it from my perspective. So that's the first consideration. And the second one is risk. We have low risk. We have high risk. And risk really comes down to how well can we predict how much time it's going to take us to do this work. If I'm selling a very templated, productized service that I know, I'm going to get to within 10% of the hours that I estimate consistently, then that's a low risk work. If I'm being asked to build custom software on a new development language that's not very well supported, to do something that's novel, that's impossible to scope, basically. It could take 100,000 hours, it could take 1 million. And so it would be irresponsible for me to try and agree to a fixed price on something like this. So that's two extreme examples of risk, but we really want to identify like how well can we scope this thing. So if we have work that is high risk and low value, typically this is where time and materials billing or hourly still makes a lot of sense. Because as you recall earlier, as long as we can make sure that we have a 60 to 70% gross margin on every hour, we're still profitable. So the game here just becomes try to get the client to share as much risk as possible, try to keep your labor costs to a point where you can charge an hourly rate that gives you that margin, and just try not to eat too many hours, right? Try to make sure that the client is paying for the hours that you're working and that you're tracking them. That's the game on time and materials. If we have low value, low risk work, this is where flat fees work really well. And so an example of this is if you asked me to build you a website and I said it's $500 an hour, you'd probably tell me to go pound sand. But if I told you I could get you a blazing fast, proven to convert agency website that's SEO optimized, and I can get it to you in 2 weeks, and it's only going to cost you $5,000, you might say, that sounds like a great deal. Where do I sign? I might still make $500 an hour, but that doesn't matter to you because you've agreed to a flat fee of $5,000. And what I'm doing here is I'm arbitraging risk. Because I know how long it's going to take me, I can create certainty for you as the client, and I can arbitrage my efficiency to increase my profitability. So that's a good place to be for low value, low risk. If we're high value, high risk, this is where we start to get into what I like to call abstracted time and materials. And so this is where we are billing. The contract language is similar to time and materials. We're sharing risk with the client, but the pricing is not tied to an hour. It's tied to a larger bucket of time. So Media Monks does this. Lots of other custom development shops that do enterprise work that I know do this kind of pricing where they say it's $20,000 per sprint. And we think this project is going to take between 26 and 32 sprints. In your team, you're going to have 2 full-time developers, half an architect, a project manager, a half a designer, and a quarter of a strategist. And that cross-functional team is going to work with you in an agile method to get this project done. And what inevitably happens with almost all of those projects, by the way, is they turn into 3-year engagements where the team is basically being leased out to the client at a very high profit margin. And what we do is we use, again, the fact that this is high value to abstract the conversation away from the hour and increase that hourly rate, but we're still protecting ourselves from the high risk nature of the work by tying the contract to more of a time and materials model, where if it takes more time, the client is still liable to pay for that additional time. Because what tends to happen, especially with those projects, is the scope changes constantly after the start date. And then finally, high value, low risk work. This is where we get into our beloved value-based pricing. And the main difference here is we're still generally setting some kind of a flat fee, but instead of saying it's $5,000, we're having more of a nuanced conversation, something to the effect of, well, if we were able to get you this outcome, what would it be worth to you? Oh, $1 million in sales. Well, would you be willing to invest 10% of that? That's $100,000 to get that thing done. If we want to get very advanced and the risk extends not only from scope, but to outcome, then we can go to the most risky, but also most advanced form of value-based pricing, which is performance-based pricing. So if we know that there's low risk around the outcome that we provide, that we might even say something like, we'll charge you a base fee of $20,000 plus X% of every additional sale above what you're currently doing today. If we were really, really confident that we get that upside, and that's how we could stretch that price even higher by taking on more risk. But again, this is just a question of, again, arbitraging risk while also arbitraging high value. And of course, this is the way to get the price as far away from cost as possible, but it's not always appropriate, usually when the risk or the value just aren't there to justify that kind of conversation. So hopefully this is insightful. This is kind of how I think about this, and gives you maybe a lens to go evaluate your pricing and your services through.
Brilliant. I'm glad I asked the question, and I'm sorry I asked it toward the end. But no, that was really cool. Hey, Marcel, do you want to pull back your page as to where people can know more about you? There you go.
Yeah, there you go. Go grab the toolkit, folks. It's free. It's loaded with lots of free stuff. And if you thought today was helpful and valuable, then there's lots more videos of me gabbing at you about numbers in the toolkit. So feel free to go check that out.